yearly result. The first quarter, like-for-like sales are up 0.3%. That was actually below what the market was expecting. While the second quarter part of this result, that result was a little bit disappointing. Like-for-like sales did fall around 1.4% over that quarter. Even over that Christmas period, we saw margins down a bit because of the heavy discounting you see over the Christmas and the sales season. But looking at the full year 2013 expectations, probably expecting a pretty flat net profit result, pretty flat in terms of sales as well. David Jones has guided to only very modest increase in net profit over the full year. But the sales trend for David Jones does seem to be improving. It reflects that Christmas period and the sales period. But it also, they did note that the levels that they've been reducing their prices have fallen. So price discounting's down about 5%, while their promotion time period's down around 30%. So they're actually seeing an improvement in their margins. In the result today, we saw 110 basis points to their profit margins. That actually missed our expectations a little bit. We're looking for around 160 basis points to around 39.5% profit margin. But I think still a very good result here. And you've got to remember, David Jones is another one of those discretionary retailers that's very heavily shorted on the market at the moment. Around 13% of its shares are short sold. So with an improvement in sales throughout the year and a pick up in consumer confidence, it's one of those discretionary retailers that could do fairly well. It does trade on a bit of a premium to the other big retailer, Myer, on the market at about a 7% premium. So David Jones does look a little bit fully valued at the moment. So to be wanting to buy into this, I'd be wanting to start seeing some earnings upgrades before we're going to see a significant rise in the share price.
Evan, is the tide
small correction in the banks, but at longer term, I think the banks still look pretty good. I think you've got to look at what's actually driving the share price movements within the banks. If you compare the Aussie market to the US market, our market yields around 5%. The US market, S&P 500, only about 2.1%. So they are expensive, as JP Morgan noted, relative to peers. But at the moment, looking at 2013 yield for the Big Four, still ranges between 5.6 and 6.1%. And on a one-year forward-looking PE, they're trading around 12 to 14 times. So the valuations are fairly lofty for the banks. I don't think you can argue the other way. And those PE ratios do factor in pretty optimistic, but probably achievable earnings as well through 2013. Because looking at the results we've seen recently, they've continued to improve earnings. You know, funding costs have come down. So I think there's a couple of key risks for the banks moving forward. One would be unsustainability of dividends. ANZ looks good in this respect because it does have the most sustainable payout ratio and the best upside in terms of payout ratio of dividends. And of course, higher interest rates are going to make this yield play in the banks look less attractive. So I think maybe a small correction in the banks, but longer term, they're going to be pretty well supported.
All right, guys, look, got to leave it there. As always, great to get your thoughts, in particular those equation.
Let's just update you on how some of those stocks in the iron ore related to that